So hello guys, welcome to my YouTube channel. It's KelFX here. So in today's video, we're going to talk about order blocks. What are order blocks, types of order blocks, and how to properly identify them. So before any further ado, gotta do the YouTube stuff. Not a financial advisor. Any topic discussed here is based solely upon my own experience and deep understanding of smart money concepts. All right. So all right, let's get into the video. So in today's video, we're going to talk about order blocks. And what are order blocks? Well, the general understanding surrounding order blocks is that they are a collection of orders placed by big banks and financial institutions in order for them to move price in their direction. So what it basically means is that when banks and financial institutions place an order, they usually don't risk their whole capital in a single trade or a single position. They actually have to distribute the orders in chunks of blocks, and that's what we call order blocks, right? And there is another thing that is very, very important to understand is that in order for price to move, institutions need liquidity. So there needs to be liquidity in order for price to move aggressively. That's why there is a general saying in trading is that if you don't know where the liquidity is, you are the liquidity, right? So there are two types of order blocks that we have to understand is that we have the bullish order blocks and we have the bearish order blocks. Pretty much the bullish order block means that is the last down candle before the up move, right? So you can clearly see in this schematic right here that we can pretty much say that we have a bearish trend here. And then we have the first order block. Now, there is about liquidity. It's important to understand that there is liquidity sitting at every high and low in the charts, right? So whenever you see this low right here, let me just use the brush tool. So we have this low, we have this high. There is liquidity sitting at this low because there are people there were enough buyers here, enough to push price to this high. And there were enough sellers here, enough to push price to violate this previous low. So that means that banks actually were able to grab the liquidity that was sitting at this structure low. Then they pushed to the upside, pretty much protecting the highs, right? And then they've actually violated the lows right here. So pretty much there is liquidity sitting at high and low. So in this scenario right here on this bullish order block, we can clearly see that institutions had to sell first to grab liquidity sitting at structural low. Then they had to buy immediately to the upside, pretty much trapping all the trendline liquidity, trendline traders, right, that were sitting up here. There are people that were waiting for these triple tops right here. Everybody that had orders, they got taken out, right? So banks actually here, they actually have to sell and then buy. So this first break of structure right here presents us an order block right here, which was the last sell candle before the up move. Right? So it's the same thing we have when it comes to bearish order blocks. We can clearly see that we have structure highs and structure highs, structure lows. Pretty much this was a bullish trend. And we can clearly see that we have the first break of structure. Pretty much this is what we call, some people call it chalk. Some people just say break of structure. That's totally fine. So we have this break of structure to the downside. So as we can see, institutions, they had to sell first to take the previous high liquidity that was sitting above. Then they had to sell immediately, right? So that most of the times this move comes with a huge aggression. That means that a lot of their orders were stacked in there. And I think that's one of the great things about smart money is that we get to see pretty much the banks and financial institutions' footprint so we can better position ourselves in the market, right? So here in this scenario, they had to buy and then they had to sell. Now, there is another thing is that when institutions and banks and institutions buy to take out the previous high liquidity, they usually don't use stop losses. So pretty much it's something like this. They actually have to buy, right? They actually have to buy to take out the previous high liquidity. Then immediately they have to sell, right? To trap everybody that was sitting right here, because we can clearly see that we had a trend line pretty much forming right here. Right, so this pretty much is accumulation of orders. There are people that were waiting for this tap. They set a buy order here. There are people that waited for the double top, the double bottom, sorry. So they actually bought here. Then there are people that waited for the third touch, right? So they bought. So pretty much institutions look at this as a liquidity buildup. So they actually look at this actually is the reason why they move price with a huge aggression. So the reason why they bought is to take the liquidity of the previous high. Then they had to sell immediately to trap all these trend line traders right here, right? So usually when they buy to take the previous high, they don't use stop losses. And what it means is that if they use a stop loss here and they sell immediately, that means that they're actually accepting this loss right here. And as we know, banks and financial institutions are greedy. They don't want to lose money like that. So they leave this position open, this buy position open, right? And that's when we have this right here, price actually comes back into the order block that was responsible for taking the previous low. And then we have the move actually carry on to the downside. So this mitigation right here, price actually respecting this order block that was responsible for taking the previous low is what we call mitigation, right? This mitigation pretty much means the banks and financial institutions, they mitigated that buy order right here. And now they carry on to the downside. So sometimes what happens is that there are retail traders that are waiting for something like this. They have this key level. And as soon as they see this break, they're waiting for the break and retest, right? They're looking for this retest right here so they can sell to the downside. This is some of the reasons why they trap the break and retest traders. They actually come to the extreme, right? So they can then move price to the downside because the order block is sitting above right here. So most of the times there are situations that it may work for the trend line, for the break and retest traders. Price actually may react to the bottom of this previous low right here. Sometimes price can just tap here and drop to the downside. And that is what we call breaker blocks. That's when banks and financial institutions close their positions in break even. That's what it's called, breaker blocks. So sometimes they're just, price will just come here at this key level and then drop to the downside. But any topic related to breaker block, I actually make a video specific for that, right? So pretty much that's it for the types of order blocks. Now, we have this scenario right here, which is very common in the markets, is when we have this sort of a consolidating market, right? A range market right here. Pretty much we have an equilibrium between the buyers and sellers, right? So they're actually, right here, you can clearly see that we have about 4 taps, right? On the upside and downside. So pretty much what happens is that banks right here, they had to sell to take out all this liquidity that were sitting below. And they already know that there are people that looking at this as a key level, and they're looking to sell. They're looking to sell at the break and retest, right? The break and retest traders, they're waiting for the retest of this support zone so they can sell to the downside. That's why they push aggressively to the upside to trap all these people. And they already know that they're also buy the break and retest traders here, waiting for the buy, right? Because they broke this ranging markets, and now they're waiting for the retest at the support, at this resistance zone right here. So this is why actually they push price to this order block right here sitting below, and then they push to the downside, pretty much trapping all the retail traders, right? So pretty much we as a smart money concept traders, we're not saying that we're not retail traders, but the great advantage that we have is that we're actually able to understand the banks and financial institutions' footprints so we can better position ourselves, right? So pretty much this is actually something that is very common. So you can clearly see here that they had to sell to take the liquidity sitting below, then they had to buy immediately. So as they don't use stop losses, that means that this sell position that they open first is in drawdown. So they need to come back here to mitigate their positions and carry the move to the upside. So pretty much that's how they move the markets, right? They're always waiting for liquidity. Pretty much liquidity is what makes banks and financial institutions to place big sum of money, right, into the market. So now let's look at how we can identify order blocks on the charts, right? So we can clearly see here on GBP USD, we can clearly see, for example, we have this structure high and we have this structure low. Then price actually broke this previous high, right? We can clearly see that this high was liquidated right here, right? So let me just mark it up as break of structure. So then we have this order block right here, last down candle before the up move, right? So pretty much here, that's when the banks actually stacked up buy orders so they can push price to the upside, pretty much liquidating this previous high. Then we have a return to order block. Why is that? Because we can clearly see this structural lows that was sitting right here that got liquidated, right? So pretty much what they did is that they actually sold right here to take out this previous low. Then they bought immediately to take the previous high. Then they had to come back into the POI, what we call mitigation, to mitigate this sell position that they had. So when they come into the order block, that means that they actually get to close their positions at a little bit of profit. Now, if they actually use this this zone right here, this key level, and let's say price actually tapped here and kept pushing to the upside, that means that they actually closed their positions in break even, what we call breaker blocks, right? But in this scenario, they were able to close their positions at a little bit of profit and then carry on the move to the upside. That's why we see right here that now we had this break of previous high. Pretty much the lows now are being protected, right? So we have highs being violated, the lows being protected. So price actually broke structure to the upside. We had this return to order block right here. Pretty much price coming into this zone because we have this last down candle before the up move, right? And then we can clearly see that this bullish momentum actually was being respected all the way up here, right? We have the break of structure. We have this last down candle. This was actually the decisional sell before the buy that went on to take out this previous high. We can clearly see price actually dropping a wick right here, pretty much mitigating this order block right here, right? Then we have another break of structure right here. We can clearly see price actually broke structure right here. We have a down candle before the up move right here. Pretty much price mitigated this. Now, what happened right here is that we can clearly see the bullish reluctancy, right? Pretty much is price actually failing to put a higher high, pretty much price failing to take out the previous high. So this pretty much is a sign that they actually want to reverse. Pretty much they want to move price, they want to push price to the downside. And why is that? It's because if you look at this, we can clearly see that they actually build, we have this liquidity build up right here in the form of ascending channel, right? So we have this ascending channel, pretty much it was just huge liquidity being built right here. So this right here is one of the reasons why banks and financial institutions move price the way they move, right? So they actually want to grab all this liquidity sitting below here, right? So you can clearly see that this failure of price actually giving a high, and then price actually breaking the previous low, this low right here. We can clearly see that this low right here that was responsible for pushing price to the upside, this attempt to actually give a high, actually got violated. So we had a break of structure right here. We can clearly see we have this extreme up candle before the down move, right? The last sell, the last buy before the sell. So we can clearly see that price actually broke structure here, came back to mitigate the order block and broke structure again. We can clearly see here that we had another order block right here. We can clearly see what is the last up candle before the down move sitting right here. We can clearly see price actually came back to mitigate that position and then drop, continued to the downside. Now we can clearly see, okay, we had another break of structure. Where is the last up candle before the down move, right? We can clearly see here, this blue candle, the price. So price pretty much came here. So if you have this, for example, this is the daily chart. If you want to be more of a swing trader, you can pretty much set your limit order right here, a sell position. Soon as you see the break of structure, always ask yourself, okay, what is the last up candle before the down move, right? That was responsible for breaking. Now, you can clearly see that some people will say, okay, I'm seeing this up candle right here before the price actually violated this previous low. But there's another thing that you have to understand is about imbalances. I'll actually make a video on fair value gap, is insufficient price action, and which pretty much is the same thing as imbalance. But pretty much you can clearly see that we have this imbalance right here, which pretty much is a gap. What that means is that here we didn't have buyers. There were not enough buyers to counter this sell move right here. We can pretty much see that this candle right here had a huge volume, right? And it left this gap right here. We didn't see a wick actually coming to fill this gap. So that means that there were more sellers than buyers at that time. So the buyers couldn't counter this sell move to break this previous low. So that means the price actually needs to come back up, right? Fill this imbalance and then drop to the downside, right? So pretty much that's how price moves. We can clearly see here. Now, if you decided to sell, you could look also, you could actually sell from the institutional, from the imbalance right here. You can actually set your limit at the fair value gap and make sure you cover this high right here where the order block is sitting at. But as a means of refinement, we always like to look for the last up candle, the last buy before the sell, right? So pretty much that's it. You could have your stop loss actually covering this high right here. And your first target would have been to take out this low, because we're actually seeing this bearish order flow being established. So pretty much we know that now the highs are being protected and the lows are being violated. So if you actually take an entry here, your target is a reasonable target is to take out this previous low, right? So we can clearly see here we had this break of structure to downside. Pretty much this was just price releasing right here, right? Because price, they can't always come back. They can't just break structure and mitigate all POIs, because that is just building liquidity. We can clearly see that there is a ton of liquidity sitting above right here at this mitigation play right here. So price needs to release, right? That's where we had this strong push to the downside right here, pretty much huge momentum right here. We can clearly see that we had another break of structure here. The last up candle before the down move, we can clearly see here, right? That's the POI. Then we had this successful retrace and then a second break of structure. Now, the second break of structure actually had a very clean POI, which we can see here. We can clearly see that this was the last up candle before the down move right here, right? So we can clearly see that price actually respected this order block, actually violated the previous low. So if you actually look to take this trade, you could have, from the daily time frame, you could just set your limit order right here, a sell position, and your target is to take out this previous low, pretty much just to keep the bearish order flow intact, right? So pretty much that's it. That's pretty much how banks move when it comes to order blocks and mitigation, right? So pretty much that's it for this video, guys. And I'll actually post more contents related to smart money concept, because I think there is a lot of things that we need to address, certain details that are very important. And the great thing about smart money is that it enables us to pretty much see where the banks have been involved and how we can actually join that move, right? So that's why we're able to have a very good risk to reward ratio using this strategy, right? So just to sum it up, I hope you guys actually like the video, and make sure you like the video and subscribe for more content. Give me a comment on down below to see if you actually enjoyed the video, and see you next time.